You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the Option Industry Council's webinar series. My name is Nick Ziegler, and I'm a staff member here at the OIC. I'll be guiding you through today's session. We're glad you could join us to learn more about options as a flexible, powerful trading tool. And now, ladies and gentlemen, Joe Burgoyne will introduce our panelists for today's topic, what volatility means for your investing. Joe?
Hey, Nick, thanks so much. And as always, thanks to everybody for joining us. We do have a great panel today, and why don't we just get right to them, let them tell you a little bit about themselves. Frank Fahey, why don't you get us started?
Well, thank you very much. I have 30 years experience as a professional trader. I came to the CBOE in 1985 after working for IBM and Digital Equipment, and saw the opportunity to learn and trade. That's when I met Dan Sheridan. So between us, we have 60 years experience. Pretty scary. That's basically it.
All right, that's beautiful. And how about if we bring in Shawn Howell from Pro Market Advisors? Shawn, tell our listeners a little bit about yourself.
Hey, thanks for having me on, Joe, and thanks for attending, everyone. Well, I don't quite have the length of time, but I'm realizing that I've spent 50% of my life now in this industry, in the brokerage industry. I started at 24 years old at Charles Schwab back in 1994. On the retail side, studied for my 7, went on to work with super hyperactive traders, day traders, option traders, and then high net worth traders as well. From Schwab, I was lured away by InvestTools, was instructor for them for a couple of years. That merged into the Thinkorswim platform, where I ended up running one of their educational divisions up until about 2009, when I started Pro Market Advisors with my good friend Rick Swope. And we do education now. We've done quite a bit of education with OIC, Chicago Board Options Exchange, and then in the U.S. we work with E-Trade to educate their clients. Canada, we work with Scotia iTrade, and then in Europe we work with Axo. So thanks for having us on. We're looking forward to, or I'm looking forward very much to talking about this and hearing what Frank and Dan say as well.
And Dan, why don't you tell us about what you're doing there, Sheridan Options Mentoring, and your background as well.
Oh, sure. Yeah, I grew up in wonderful Chicago, and I was down at the CBOE for 20-some years, working with the specialist firm Mercury Trading with John and Pete Nigerian, among others, and I had the pleasure of being in the pit with Frank Fahey, who's on the panel here for many years. And about 15 years ago, I started Sheridan Mentoring, just a continuation of teaching. I did most of the teaching at Mercury Trading, most of our traders, and I've been teaching with the Options Institute probably for about 25 years or so. And basically at Sheridan Mentoring, just try to help people with monthly income on live trades and just try to help them. It's a craft that takes a lot of time, and just trying to help a lot of the baby boomers make a little bit of money each month. That's really what I do all day.
Amen to that, Dan. And listeners, as you can tell, we got a great group here. Before we get back to them, let me just go through a couple housekeeping things. I think those of you in the option space know that the industry does provide that document, Characteristics and Risks of Standardized Options, speaks to the benefits and risks of listed options. Be sure you have a copy if you can get one from your broker or from the OCC. Speaking of the OCC, they are the world's largest equity derivatives clearing organization and the foundation for secure markets. They, along with the exchanges, do fund the OIC. The OIC has been around now since 1992, really to just educate investors, financial advisors about the benefits and risks of the listed options product. And these are the different parent companies for the U.S. listed exchanges. And for those of you who have listened in before, you know this is one of my very favorite slides. It's the growth of the U.S. listed options industry. Started in '73 in Chicago. I think 928 contracts, 16 different companies. In April of 1973, we're now averaging just under 17 million contracts a day on the 14 exchanges. A little over 4 billion contracts trade annually, in the industry at this point. So with that, our topics today, the name of this is what volatility means for your investing. And we'll touch on a lot of different ideas, but I think in a broad sense, and maybe Dan Sheridan, I'll start with you. What does vol mean for you and your investing in a broad sense, not so much just options as we get started?
Okay, in a broad sense, volatility is changed dramatically. When I was in the pit for 20-some years, I use volatility much differently than I look at it as a retail trader. But volatility more kind of where the market is, Joe. With VIX today at approximately 14 and the SPX today at 2076, approximately 55 points off the all-time highs, these numbers give me more as broad indicators of where the market is and where premium levels are in the market. So they give me some information from a broad scope, how I might structure some trades and how I might look at the market, how I might want to ensure maybe positions like covered rights. So the volatility structure, again, looking at VIX at 14, gives me an idea where the market is. If VIX is 12 to 14, we're not going to be in the midst of a correction. We're going to be at higher levels in the market. So from a broad scope, it tells me the scenario I'm walking into. What's the arena I'm walking into, and what type of trades that I might be looking at.
Okay, that's a good start. Shawn, how about if you add your thoughts to this discussion?
Yeah, I can pretty much overlay some thoughts on top of what Dan was talking about. When I look at volatility at its rather low state right now, I'm seeing a little bit less opportunity for me as a premium seller, and it changes a little bit about how I'm going to think as far as strategies that I have to go to. When I see volatility expand, I see some higher VIX numbers. I get a little bit more excited. I like to sell premium, so I see that as options being a little bit more juiced up and an opportunity for me to extract some more income from the market. I do like the income side of the market. I do like the income strategy. So volatility to me says more credits on my side, more juice.
Well, I know the three of us will certainly get into conversations about specific strategies, but Frank Fahey, in a broad sense, what are your thoughts?
Well, I look at volatility as two different things. First, we have the volatility of the underlying, whether it's the SPX, IBM, or Monsanto, and that gives me an idea of the average daily move of the stock over statistical move, the average statistical move. Then we have the implied volatility or volatility of options, which is basically a measurement of the premium that's in the options themselves, that premium that doesn't have value directly related to the price of the stock. We call it extrinsic value. Now that may sound complicated, but it in fact is really pretty simple. And I didn't make a dime trading my first 2 years until I figured out volatility, both statistical or historical volatility and the implied volatility.
Okay, well, I think as we, and you laid that out there, Frank, let's be crystal clear on exactly what historic and implied volatility is. Would you give me that one more time, Frank, just so our listeners are clear on that?
Historic volatility is a measurement of how much an individual underlying product moves on a daily basis. It's usually a percentage of the standard deviation. You'll look at it. The higher it is, the more it moves in real terms as a percentage of the price on a daily basis. Usually it's a 30-day running average. Implied volatility explains the difference between the premium in a stock. The best example would be why, when you have two $50 stocks, is the 50 call on one $5 and the 50 call on the other $1. That $4 difference is due to a difference in what we call implied volatility. And it's a measurement that allows us to reduce the complex to something simple.
Keeping it simple is good for all of us. And I don't know, Dan or Shawn, just I really am a big believer that this whole idea of volatility in the option space is critically important to our listeners. Do you want to add anything in terms of this historic vol, I-vol conversation? Shawn?
Yeah, I like what the way that Frank had explained that you can better explain why you've got a $50 stock that has a different premium than another $50 stock, because when you're looking at the two components that are going to make up an options value, and they're both $50 stocks, if they're both $1 in the money, $1 is $1 regardless of the stock. But when you're looking at 30 days of time for stock A versus stock B are going to be different. So it allows you to compare the two stocks to see which one is going to at least have the anticipated higher movement over that same amount of time. But another thing it allows me to do is if I can take a look at that $50 stock and I can see what the historic volatility is. Maybe I've been writing covered calls on this thing for a couple of months, and I know that an at-the-money covered call is going to yield me, let's say, 3%, and it has consistently yielded me 3%. But then suddenly I get ready to do another covered write, an at-the-money covered call, and it's still 30 days out, and I see now that I can get 6%. So what's changed? I look at the news. The stock hasn't really changed very much. It doesn't seem to be moving very much, but that increase in the options value is the result of the implied volatility and the implication or the prediction that something in the next 30 days is going to move this stock more than something historically has, and that tells me I need to dive deeper into the stock or the sector or the industry to see what may be getting people comfortable with paying higher prices on calls and or puts. So it's a clue to me that there's something going on underneath the radar that I need to look into.
Okay. Dan, not to beat the dead horse, but anything you want to mention in terms of a historic vol or implied vol?
Yes, and I'd be happy to beat a dead horse a little bit if we need to. But I don't look at, again, as a retail trader, I don't look at historical volatility that much. I did more when I was a professional trader. I look at more historical volatility is what did the stock do yesterday? What did the stock do last week? I think that's helpful information, but I'm more focused on the implied volatility. And I think for your retail trader, one way to get your arms around it is the implied volatility number itself means absolutely nothing, right? If you look at $100, or let's take a $50 stock, and you have the at-the-money 50 call is trading at $2. What does that mean to a retail trader? That itself doesn't mean anything. It doesn't mean anything until you put it in a perspective. When I come home from the grocery store on Saturday and I buy a pint of blueberries for $5, I don't know what that means, right? I just do what my wife tells me. But when I get home, I get an immediate response. You paid $5 for a pint of blueberries. Now, what does that mean? It means that my wife is in her mind looking at the range of blueberries over the last year, and the range is 2 to 5, and I paid 5, and that's bad. Now I understand it. For a retail option trader, if they pay $2 for a 30-day at-the-money option, what they need to do first of all is look at that implied volatility number or metric, and it says, look at that $2 is a 30 volatility. Now you look at that 30 volatility over the last year, and that gives you perspective to let you know, hey, is that $2, did you buy that, is that cheap or expensive in relation to the last year? So implied volatility numbers are no different when you start looking at somebody shopping at a grocery store. Are those cheap blueberries in relation to the last year? And implied volatility, it can help a call buyer know that, hey, did you pay up for this 30? If you look at 30-day options over the last year, in the range you're paying sometimes $2, sometimes $4, it just gives you an idea, is it cheap or expensive when you're coming in? So I think most retail traders, I don't think, use volatility that much in terms of the implied volatility, but it's a helpful measurement to let you know when you're paying up for an option.
Okay. Well, I do want to get into volatility and option strategies, but before we go there, you bring up a really important point, Dan, this whole idea of what do retail investors focus on. Shawn, in your experience, do you have a top 1, 2, or 3 areas that investors should focus on before initiating a trade?
Well, I certainly think that they should be focusing on volatility, but I don't think they understand it enough. So webinars like this, I think, help to serve that purpose. What they tend to focus on, of course, is going to be direction. And besides the fundamentals that most of your investors do, most of your traders have been trained as technical traders. And I think there's definitely a place for that. But I think overlaying understanding the Greeks and the option strategies is very important, because what the volatility is telling you is what the historic move and the expected move is going to be and what the market is willing to pay for it. But when you overlay some of the technical analysis in that, and you start looking at some of the support and resistance points, that starts to lend itself into what strategy may be in line with both the technical move and the Greek move that you can anticipate as well. So I think people need to combine all of those things together to come up with something that they're comfortable with. I know in all my retail years, we didn't focus that much on Greeks, but then when I start working with folks that are from the SIBO off of the floor, there's this heavy emphasis on that, which I think is great, and I think you can take the best of both worlds and combine those together, and that's what I try to do in my teaching, at least, and what I do in my own trading.
And, Frank, how about you? Any different approach when you're educating?
A bit of a different approach, because I, like Shawn, like to emphasize the Greeks, because the Greeks allow me to reduce the complex to something simple. And that's real important because we're assaulted by so many things. Trading, I have 6 different screens in front of me, but I need to reduce it to the lowest common denominator, and the Greeks do that. When I first started out, I was concerned about direction. The Greek for direction is gamma, or delta, which is the underlying equivalent, and how fast that delta changes, the gamma. Then we have time, which is your daily decay, the money coming in or going out from the position, which is theta. When Danny and I first started trading, we didn't even know what vega was, which is the measurement of volatility. And it's one of those things where I would strongly stress learning the Greeks and having a feeling of where you make or lose money on a daily basis on each one of those combinations of measurements. And it seems overwhelming at first, but then it gets to be pretty easy over time.
Like anything, I think it's a question of getting used to it. So I'm not sure who wants to take that, but I want to kind of follow up. Okay, somebody's relatively...
Hey, Joe, can I follow?
What's that?
I was just going to add one. I mean, because you're talking. Yeah,
please.
Could I add one? Yeah, just in terms of, because I think it's important in terms of. I think the question, as I get older, it's interesting, Joe. I forget what the question was, but I think it had something to do with how do we structure trades, or how did you word it? It was more. What do we look for at the beginning of a?
Yes, exactly, and the progression of what you look at.
Yeah, I think, what I've seen with most retail traders, they can't get out of bed in the morning and put their pajamas on without looking at charts. And I think one, just my opinion. So I think 80% of the problem, and this is just my opinion on why retail traders sometimes that I see them struggling, is because their whole existence of making money is what's their opinion, right? What's their opinion on where do they think Apple's going, and where do they think Apple will be in the next month, and then they structure a trade. I don't know if I could I'll be honest with you, I don't know if I could make a living based on my stinking opinion, right? And I think, so for me, I don't teach, I'm aware of price levels, I'm aware of where they're at, but I structure in what I teach and how I structure my trades and my businesses strictly on positive theta trades. I put on trades that have probabilities in their favor or time decay working for them, and rely on some risk management and put similar trades on over and over. So I'm not, again, I think 90% of the retail public, and I think to me, just from what I've observed teaching for 15 years, the problem is their stinking opinion. I don't care about their opinion, right? And I think as I see people structure trades on probabilities and positive theta, and as they manage the risk, and they do this over and over and over and over, then that's how I structure the trades. I'm not saying I don't ever look at a price chart or something like that, but I think that is really the problem with retail traders is their basis of making, even if they understand the Greeks, a lot of them are coming in with their opinion. And I have not seen many people in the last 20 years that are consistently doing well based on their opinion of the market every 2 weeks or every 3 weeks. So anyways, that's my long-winded 2 cents on how I look at structuring trades and stuff.
No, let's actually build
I agree.
on that, Dan. Frank agrees. Well, you guys stood next to one another in the pit, so that might be understandable, Frank. Dan, let's build on that, and again, in the context of today's presentation, which is on volatility, you got an open canvas, and Dan, I'll go back to you, and then Shawn, and then Frank. Walk us through a specific trade, because we do want to offer our listeners, different just ideas. So walk us through, your approach. Go for it.
Okay. So maybe give a trade example. Is that what you're asking?
Yes, please.
Okay. So just a trade example, just a basic trade that we may put on is, let's just throw out a iron condor. Or butterfly. Oh, we'll do a butterfly since Frank, yeah, a butterfly. But let me just say this before I'll go over an example. So the example would be XYZ is at $100. And let's say we're just looking at calls, okay? We're looking at calls. We're looking at XYZ. XYZ's at $100. I'm going to sell two XYZ 100 calls. These are 30-day options. So I'm selling the option that has the most time premium. And remember, volatility measures the time premium part of an option. So I'm selling two of the 100 calls. I'm buying one of the 80 calls, and I'm buying one of the 120 calls. So again, XYZ's at 100. I'm selling two options. I'm selling two options that have the most time premium part of an option. So volatility is basically the part of an option that is extrinsic value or time premium. So I'm selling the one that has the most volatility component, and I'm buying the 80 call and the 120 call. Now, this type of trade is called a butterfly trade. I'm doing it, in this particular example, all calls. And so this is the type of trade that I would put on. Let's say I'm doing a 30-day trade. I put it on every 30 days or so until I'm 97 and a half years old. And that's maybe where I might differ in my approach. I'm putting it on whether the volatility's high, whether the volatility's low, whether the volatility's fat, whether the volatility's skinny, and I'm relying on managing this trade. And so you're doing it over and over, whether you do it a duration of every 14 days, every 7 days, every 30 days, whatever you do. In this butterfly, obviously when option volatilities are higher, I'm selling more time premium in at the money option. When implied volatilities are lower, I'm not getting as much. But I'm still managing, to me, I think one of the fallacies, Joe, is that people want to sell volatility when it's high and buy when it's low. I don't. I'd rather, to me it doesn't matter. There's a reason, there's two main reasons why option volatility gets high with stocks. The two main, not that there's not others, but 90% of the occurrences are going to be because the market gets hammered, like we've had two corrections in the last 8 months. When the market gets hammered, option volatility goes up and around a stock's earnings. And so to me, those aren't exactly walk in the park, grab a lemonade, wow, the market's getting hammered. Let me just sell option volatility. There's more to it than that. So anyways, the bottom line is I like to sell time premium at the money in the form of a butterfly type trade. Now, again, we're not getting into the craft of how to successfully trade a butterfly, but I'm in it every month. I don't care if the market's high, if the market's low, if I'm feeling good, if I'm feeling bad. I'm putting it on all the time, over and over and over, and relying on risk management, not my ability to pick direction to make a living. Anyways.
And Dan, without getting into the craft of trading the butterfly, but just quickly tell our listeners the optimum place for the underlying to be at expiration, and if you typically hold a position like that to expiration.
Yeah, if I'm doing a 30-day butterfly, generally I'm going to be in and out of this thing in 10 days or less. So if so to make a guideline, whatever my duration of time is, I'm going to be in the trade a third of the duration. So if this is a 30-day trade, generally I'm going to be in it about 10 days. I might be looking for 10 to 15% profit during that period of time. You make your most in a butterfly at the short strike. Why do you make your most money in a butterfly at the short strike? Because at the short strike, and generally this type of trade, an all-call butterfly, it'd be for a debit. And that can confuse some people, but I'd be paying $5 debit, $7 debit. But what happens at expiration at the short strike is all the time, basically whatever you sold that option for, it goes to zero. So all the time premium that you sold, whatever you sold that short option, if I sold the short option for $3, it's going to zero. right? And the other options, because they either had a lot of intrinsic value or they didn't have as much time premium, you sold a lot more time premium than you bought. So if we're at $100 in this example at expiration, you're going to make your most money because of the decay of the 100 calls. So this is not a probability trade. You're not making money because of probabilities. You're making money because time decay, but you can get the probabilities in your favor in this type of trade if you're in it for a short period of time. And I think people get used to, well, I'm going to hold this trade till expiration. Again, is a guideline. If I'm in a 30-day butterfly, 90% of the time I'm out in 10 days, and the shorter the amount of time I'm in the trade, the probabilities of it staying in a range are better. Anyways, that's a lot of hot air from an Irishman from Chicago, but that's about the best I could do.
Who pays $5 for blueberries?
Yeah, who pays $5 for blueberries when they normally go for $2?
Shawn, how about a trade? And let's talk, the perspective, of course, with keeping volatility in mind. What are you thinking?
Sure. Well, I like the fact that Dan introduced the word probability into there, because one of the things that I'll encounter a lot of times, especially if I'll go up to Silicon Valley, is we'll come across people that have received large stock grants in technology companies, and they may have had these grants for many years, and they like the idea of a very basic strategy like a covered call, so they can derive a little bit of income. Sometimes these are tech stocks that don't pay any dividends, so they're wealthy in what they have in their portfolio, but they don't want to sell anything, they don't want to incur any taxes, and they're not seeing any dividends. So they like to hear about covered calls because they believe they can extract some income, but they'll come to us and they'll say, I'm concerned about losing the stock. I'm concerned about the stock moving up to a point in which the call goes in the money, and then someone is going to exercise the right, and I'm going to end up selling, and then I've got a taxable event, and I'm losing shares in the company, so on and so forth. So they may say, just how far away can I or should I sell a covered call so that I probably don't get called away? And that's where we can utilize the implied volatility value to say, well, here's what the market, we could look at historical and we could look at implied to say, here's what the market believes the stock is able to do in a month or in 3 months or 6 months, and we could work that implied volatility number backwards to say, here's what the market doesn't think that it's going to do. And then we could use that one number, we could talk about standard deviations, and we could say, well, there's a 68% chance that the stock is not going to reach that first standard deviation, and here's the premium on that. And they may say, I'm not comfortable with that. That's still too close for comfort. Well, okay, we could go out 2 standard deviations, and now we're decreasing the probability that they're going to get called away. It will allow their stock to have more room to the upside, but they will derive a little bit of income from their covered call. Now, at the same time, they may think, well, that little bit of income that I'm deriving, can I then use that and use some of that money to basically create a floor? That floor would be essentially an insurance policy, and that would then be them buying a call option. So they'd create themselves a collar, and again, we could use the implied volatility value. We don't necessarily have to go to the chart and look at resistance and support to do that. We can utilize our implied volatility to determine just how far away do we need to purchase a put so that we feel confident that we're only using that put when the stock is really doing something that is outside of what its normal range of behavior has been. So very simple ways that you can use IV, you can utilize the volatility values to figure how far away can we sell a covered call and how far away can we buy a put so that we only use it in case of a catastrophic failure of the stock price.
So, Shawn, let me build on that a little bit. Distance away from, the price of the stock is one thing. How does an investor actually manage or quantify their volatility risk?
Well, one of the ways they can do that, and when I was in Vegas, the Money Show, I was talking about building some iron condors, and the question continually popped up, and I understand where it's coming from. What deltas should I be using? And it was an interesting question because really it should have either been a chart-based question, but these were not necessarily technicians. These were more people that were focusing on the Greeks. So they wanted to know what deltas they should use, but what they were really asking me is, what's the volatility measurement that I should be looking for? And that's most easily displayed in a delta. So for example, if you were looking to sell a call that has a delta that's out 0.05, you have a very low chance. The market is telling you there's a very, very low chance that the stock is going to reach that level. Some people might say that it would be the inverse of that. So there's going to be a 95% chance that the stock can't reach that level in this amount of time. And by people looking simply at the delta and taking the inverse of that, they would say, oh, I'm comfortable with that. And they could do the other thing, and they could say, well, I want to be 95% confident that this thing is going to remain in the money. Well, in that case, then we're looking to buy a call that has a very high delta of 0.95. So we're very much in the money there. So sometimes people will utilize the deltas as a way to determine probability, which is sort of a backdoor into looking at the implied volatility values.
Okay, very good. Frank, how about what strategy would you like to offer our listeners?
Well, interestingly enough, I do both the strategies that were mentioned by each of these gentlemen. There's many paths to Buddha, and it's dependent upon your own risk-reward comfort zone that you develop over time. Dan and I, in order to develop this comfort zone, we trade the same thing all the time, again and again and again. And that's because individual products behave much the same way. And one of the ways they behave is they have a range in implied volatility and a price range. It allows us to sell stuff or feel comfortable selling options and feeling that it's not going to go outside what we call the wings. Now, along with that comfort zone, Danny was talking about doing a butterfly 30 days out and keeping it on for 10 to 15 days. I do butterflies 60 days out and take them off 30 days beforehand. We're both, like the remora, swimming in and out of the mouths of sharks and taking the bits that Goldman Sachs and Morgan Stanley leave for us, and hopefully not getting eaten by the shark, which is the market. So that's what I do. I reduce my risk by moving my time out a bit more. And I'm trading also pretty big because I do manage some people's money. So I do that. I do consulting on buy rights slash collars. That's where you sell the call and buy a put to do it, to protect it underneath. So for the Silicon Valley type people, the people with the large stock holdings based on employment. And I let the customer define what their risk is, and then we define the strategy based on their risk parameters. And that's the biggest mistake. Well, two things. You asked Shawn how he defined that risk or looked at it. I was a math major in college and have a master's in statistics, and I look at pictures. I look at the graph. That's the easiest way to reduce that risk to the lowest common denominator. The biggest mistake that retail customers do is they'll look at the expiration line, which in Danny's case would be 30 days out. Mine, butterfly, it'd be 60 days out. And they'll say, doesn't that look good? Well, Danny and I, has a window of 10 days. I have a window of 30 days. But one thing we learned as market makers is we look at what they call T+0, today or tomorrow. And if I'm not in business tomorrow, it doesn't matter how good it looks 30 days from now. But it's a constant theme I keep on hearing from the newer traders. I would be interested if Danny and Shawn think that's a common problem.
Well, I want to make one comment in the world of covered rights, just to bring along with volatility, Joe. When you look at VIX as 14 today, right? Most people would say, okay, is 14 VIX, what does that mean? And really, a low VIX number, the first thing it means is the market's been going up, right? That's really what it means. It means the market's been going up. If you're in the 12 to 14 range in VIX, and that's maybe the most widely used volatility number, it means the market's been going up, and time premiums are shrinking. Now, interesting enough, when you talk about this concept of volatility, a lot of people will hear when time premiums are more expensive, you can get a higher rate of return on your covered rights, which is true. But if we took right now with the SPX, basically what SPX is at 2076, we're maybe 50 some points from the all-time highs in the history of civilization. If I have some stocks, Joe, that are in the upper end of the range, maybe that I've owned them for a while, volatilities are very low. I may look at if let's say XYZ is $100, the stock's 100. Even though the option volatilities are low, I'm interested in covered rights because obviously you want some protection. You want some protection on the downside. But with the market at these higher levels, I would be more interested in selling something a little more in the money against my stock purchase in a covered right because I want more downside protection. And so I think that's really, I'm not looking so much at volatility, because if volatility is high, that means the market's been going down a lot, or it means there's earnings coming up. So generally with something like a covered right, I like to, in the market right now, if I have stocks that are maybe, that have rallied over the last 2 or 3 months or whatever, I'd want a little more meatier protection and sell something a little more in the money. Let me just say this in the world of collars. You hear this term collar, which is buying an out-of-the-money put and selling an out-of-the-money call against a stock purchase. And people feel warm and fuzzy and their belly button feels good because they have this graph that if the market were to collapse, they would do okay. And I just want to point out to viewers, maybe they can look into it a little more, but in most situations, a covered right, whether it be an in-the-money covered right or an at-the-money covered right, I was talking a little bit more in the money, selling a call a little bit more in the money, is going to outperform the collar. The only time the collar is going to do well against a covered right alternative is if we had a 8 to 10% or more move in a month, which most of the time in our lifetime, we're not going to have those kind of moves. And so I think you have to balance this fear. And that's what really volatility is when volatility is high, there's some kind of fear, or there's some kind of event coming up. But anyways, just again, a couple thoughts as people are looking at covered rights, some thoughts.
No, well, that's what I think is the fun part of having a panel, because we get different perspectives. And, with that, Shawn, I think a lot of our listeners are probably familiar with the whole idea of a straddle or a strangle, straddle being long the call and the put at the same strike, and the strangle being, long the put and long the call out of the money. I hear a lot of conversation about, making those trades, going into earnings, better to buy or sell. You have any thoughts or experiences, you want to offer in that area?
Yeah, absolutely. Straddles and strangles are interesting because as people are learning, they're learning about calls and puts, and they're thinking of how they're going to utilize these new tools in the real world. And I'll get a text or a phone call or an email that says, aha, I figured out a foolproof way to play Apple's next iPhone announcement, or Elon Musk's next unveiling of the next model, or they think they've figured it out. So they'll say, I don't have to be long the stock or short the stock. What I'm going to do is I'm just going to buy a call or buy a put, and then they'll go, I forget if that's a straddle or strangle. So they'll go, but it seems to be foolproof. And then I'll ask them, do the math. Do the math on it. Doesn't matter if it's a straddle or strangle, but come back to me and tell me. Obviously, when they're doing a straddle or strangle, they believe the stock is going to move. It's either going to pop or drop, but they can't tell me which way they think it is. It's either going to be taken as really good news, we're going to see a big run up, or it's not going to be looked at very good at all, and we're going to see the price decline. So I say, do the math and come back to me and tell me, what does the stock need to do? So one of my clients came back to me the week that Twitter was going to have its announcements, and he was looking at a weekly option, and he said, I don't think I did my math right, because the only way I'm going to make money is if Twitter goes up or down 18% in the next 4 days. And I said, okay, and what? Well, I looked historically, and after earnings, Twitter has only gone up something like, again, I'm sort of pulling the numbers out of the top of my head here, it's only gone up 9 or 10%. So who would be stupid enough to go and build one of these things when historically this stock has not moved that much the day after their earnings are announced? And I said, there you go. You just found the rub with a straddle and strangle, that as people clamor to the call and the put to try to offset risk, they're going to demand more of those, and they're going to drive the prices up. And if you're the buyer of that, if you're the buyer of that expected volatility, that implied volatility, then you're going to need to be really, really right that that pop is going to be a super big pop, or that drop is going to be a super big drop, because that volatility expansion makes it very expensive for you. And they say, yeah, you'd have to be a real fool to take this trade. And then that gives me the opportunity to say, okay, hold on. If the guy that's going long this straddle or strangle you feel is making a foolish decision, being that it's a two-sided market, do you want to take the other side of that trade? Do you want to be the one that is selling that premium? Do you want to be the one that's selling into that that volatility explosion with the expectation that volatility is going to collapse down and you're going to be able to collect that? And at first they get real excited about it, but then they realize the risk that they're taking. And I'd love to hear what Dan and what Frank have to say about how they work with their clients to understand now how they're going to offset that risk of being naked a call and of short the put if they decide to go and sell their premium on a straddle and strangle versus buying the premium.
Frank, you want to take that?
Sure. The way I balance selling a straddle, or let's say a strangle, meaning that two different strikes, an out-of-the-money call and an out-of-the-money put, is I buy another strangle that's even wider, which is a further out-of-the-money call and a further out-of-the-money put. And there I have an iron condor, because I do not like open-ended risk. It scares me. One thing as a market maker is I always wanted to know what my I want to define my max risk. I have to. And so as a result, in my mentoring, I teach students to use spreads, because the process of making money is not a process of maximization. It's a process of optimization, giving the market what we want.
And Frank, in finding that other spread to offset, the initial position, how do you go about defining those other strikes? Is there a special formula you have, or how do you approach that?
Boy, yeah. This may sound silly I've had 30 years experience. I have some software I use where I look at multiple iterations. It's the whole process of trading for me is, what if I do this? What if I do that? What if this happens? What if? What if? What if? So I may look at 4 or 5 different short strikes, and I'll generally use, depending on stock price, a width of maybe 5 points, 10 points on an iron condor. And that's when I say 5 points, between the short strike and the long strike. And I basically superimpose them over each other to see which one is the best. Because too often, and I'll do this when I'm lazy, and I see students doing it, I'll say, why'd you put this spread on? Oh, it looks good. And I say, well, which other ones did you look at? No, this one looks good. And I do the exact same thing, where I go, oh, this looks good. And, then I can go back to surfing the Internet. No, Frank, look at 5 or 6 more. And it's amazing how often the next 5 are better than the first one you looked at and fit my risk-reward comfort zone better.
All right, very good.
Yeah, I just want to...
Dan, please.
I just want to... selling, in this business of straddles and strangles, basically for a living, and all I basically teach is selling 2 of the main 3 or 4 strategies I will teach retail investors is selling straddles and selling strangles for weekly and monthly income. Now, before everybody gasps, I will say selling straddles and strangles, but just buying the protection. So, for example, the number one reason that I don't sell naked straddles. So I'm talking about selling options, selling an at-the-money call and put. That's called selling a straddle. And selling an out-of-the-money call and put, that's called selling a strangle. So that's what I'm focusing on here. Now, the main reason I don't sell, there's two reasons why I don't sell naked options. Number one, it eats up too much capital. And that's the big, but going along with too much capital and also there's risk, it's the yield. This is a game of yield. This is not, if you make $100 on $1 million and I make $100 on $500, I get the teddy bear, right? It's a game of yield, right? And so the two of the main three strategies we do is, number one, sell straddles. But the way we sell straddles is the example I gave before. If I sell an at-the-money call, and let's say I sell an at-the-money call and an at-the-money put, an XYZ stock at $100, and I buy my, I'll call it protection, 20 or 30 points up or 20 or 30 points down, that's called the butterfly. So selling a straddle and buying my out-of-the-money call and out-of-the-money put against my short straddle, I turn my short straddle into a butterfly. And as Frank said, if I sell an out-of-the-money call and an out-of-the-money put, and then I buy a further out-of-the-money call and put against it, now I'm selling a strangle, but I'm turning it into an iron condor.
No, very good.
One thing I would like to say, Danny and I are teaching what we trade. And so we have that experience. We'll do it a bit differently as far as strike selection, time selection. But the general philosophy on how we adjust it, when we adjust it, where we adjust it, is remarkably consistent as far as how we see risk between the two of us. And I haven't talked to Danny about this for 5 years.
Yeah, I think the overall, maybe how we look at it, I agree with you. But I think as, really the whole key is you're dealing with retail traders. And let's face it, we're dealing with baby boomers, right, for the most part, between 40 and 90 years old, right? And you know what? They want something. They're looking to, with interest rates at about zero, and they can't get any money in their bank. They're looking at, how do I make a few shekels every month without taking on a lot of risk? And so but the key to doing a trade is, it's not like when we were in the pit, we would be doing adjustments, and it was like nuclear physics at times, right? With the retail trader, very simple, right? Very simple, not because they're simple, but because it works. We're not trading the exact same way, I'm not, that I was in the pit. This is different. And just simple trades, simple risk management that they can do every month without relying on which way's the market going. So this is something that they can, repeatable trades that they can grasp without worrying about whether Fibonacci or Fibonacci or all this Elliott way or all this stuff. Who knows, right? So anyways, that's my ranting.
All part of the art.
Danny and I worked with a guy, Bob Price. He's dead now, so I'll say his name. He used to smoke upstairs in the smokers' lounge. I smoked then. Danny knew Bob. But Bob's first day of trading was October 29th, 1929. It was a tough day to start trading. And he used to say, "Hey, Frankie, every boat that ever sank had charts." And that sort of became my philosophy. I'll look for support or resistance level, but I don't look for direction. I mean, people could make millions fading my direction calls. But I've stayed in business as a trader for 30 years.
Amen to that. And I'm a chart man myself, not that, but I love that line. I love that line. every boat that sank had charts. I love that. Oh, hey, Shawn, and guys, we got about 5 minutes left. I think Frank touched on something. I want to go to you, Shawn. The whole idea of time selection. Different months have different implied levels. Is that a factor for you? I mean, for me, the questions in options trading, the two key ones: what strike, what month? Does time selection and implied volatility is implied important in terms of what month you pick?
Yeah, and I may take a slightly different approach to this than what you were thinking, Joe, but I know you and I had done your radio show a year or so ago, and I taught, I believe I taught diagonals on that. And one of the things that I hear from a lot of people is, should I be buying long-term leap options on stocks that I like, or should I be investing all this capital? Should I be selling cash-secured puts? What should I be doing? And something I point out to people when I ask them pretty quickly is, what do you think is going to happen as far as interest rates over the next couple of years? Are they going to increase or decrease? And everyone says, I think they're going to increase. What do you think is going to happen with volatility as we approach election? Do you think it's going to increase or decrease? I think volatility is going to increase. Okay, so if we've got the VIX as low as we do, and you were to buy a long-term leap, let's say you were to buy a super leap on the SPX, it's actually rather cheap right now, especially if you went in the money. So you're looking at buying basically an SPX substitute for many years out as your foundation for doing your diagonal. And then if what people believe to be true, that interest rates are going to go up and that volatility is going to increase, then when you start selling your short legs of that diagonal on the SPX, when volatility spikes up and we get maybe a VIX up at 20, then you could sell a weekly SPX against that, and then as volatility comes down, hopefully that should play well into a diagonal strategy on that. So absolutely, time is going to factor into things, and I do look at volatility from the long-term exposure, i.e. in a diagonal, in the long leg, and I look at volatility on the short leg. If I anticipate shorter-term volatility, I'm going to try to find a strategy that allows me to capture that short-term, especially if I think that volatility is going to be high and going lower. Obviously, if we see a VIX at 21 and I think it's going to go to 25, I'm not interested in selling to that side. I'd be more interested in buying. But if I see volatility at 21 and I think we're going to basically revert to the mean and come back towards assuming a 15 mean on the VIX, then I'm going to play that trade as a diagonal. So yes, I certainly do.
Okay. Well, listeners, we knew we had a lot of experience on this panel. We're talking all kinds of different strategies, most of them hedged, which personally I love. Before we turn it back to Nick, Dan, how about if I ask you for any final thoughts you have today?
I think, as far as final thoughts, I think try to encourage the investor to keep it simple in terms of maybe doing one or two or three strategies in a month. I mean, that's all we do. We don't, I'm not a big proponent of doing 40 trades, 50 trades in a month. I think that's a lot. But in the context of volatility, I think that can really increase somebody's returns. I think it can increase somebody's what I think for retail traders is this. I think that it's like you're running a race on one leg, because they're very good. Most retail traders, they're looking at the price charts. They're looking at where they think the stock is going. They've got that price part configured. But remember, on every option strategy, there's two main risks, price and volatility. So as you bring volatility into the equation, right, it will help you be a better call buyer or buying calls or puts, because you'll recognize the different levels. But you can even bring it into the next basic spread, like a vertical debit spread, a vertical spread. You're going to buy different spreads depending on the level of the premium. And then a further thing, as Shawn's been talking about, as the implied volatilities are higher or lower, that's going to affect your covered rights. So if you're only looking at the strategy depending on where you think the market is going, and then you force a strategy on without looking at volatility, again, you're running a race on one leg. And I think make it your New Year's resolution, even though we're through with a lot of the year, that you're going to study volatility. You're going to study a lot of I think the Options Institute at the CBOE, but the Options Industry Council is one of the best free sites out there that you can get a lot of good volatility information, but you need to bring that in your trading if you want to be around in 10, 15 years. I think you're running without, again, I don't mean to keep beating a dead horse, but your gas tank is only half filled. Anyways.
Thank you, you Irishman from Chicago. And
thank you,
Frank. Frank,
the other Irishman from Chicago. Oh, I'd like to just reconfirm what Danny said. There was nothing there that I disagree with. One thing that I would like to do is to reemphasize, number one, look at T+0 risk. Look at tomorrow's risk. That's the first thing. Number two, look at, gosh, I'm losing my mind. Oh, dollar risk reward instead of percentage risk reward. People tend to forget about the dollars when they're at percentages. That's it.
And Shawn?
Hello?
Yeah, Joe, I think one of the things that people don't spend enough time on, and it's actually on OIC's website, go in there and start playing with some of the Greeks and understand how your stock theoretically is going to behave if you see an increase in vol, you see a decrease in vol. People, when I show them that, they're very surprised because they're so focused on theta, they're so focused on theta cost, and they're so focused on the delta movement. When you start talking about some delta neutral trading, then they're focusing on theta, and I'm saying let's not focus so much on theta, right? Time is time. Understand how Vega, understand how an increase or decrease in volatility is going to affect your underlying price, and then people get a lot of aha moments after that. So I really try to walk them through and encourage people, spend time on this calculator and play the theoreticals out, and you'll be surprised at just how much the value of Vega, and it's probably why we're 2 minutes over. It's a very valuable component, very valuable discussion to have.
Fantastic, Shawn. Well, Frank, Shawn, and Dan, thank you very much. I'm going to turn it over to you, Nick, because as Shawn said, we're a couple minutes over.
Gentlemen, we had a great conversation today. I think our listeners were very satisfied. They had a lot of great back and forth. And ladies and gentlemen, we also want to thank you for your time today. We did have quite a few questions come through from the listeners, but if our panel wasn't able to address those questions, we do have our investor services desk here at the OIC ready to help. Feel free to reach out to them at options@theocc.com. As I mentioned, today's session will be archived and accessible in a few hours using the same link you used to join us today. Additionally, our past webinars are available on the OIC YouTube channel, so you can review a number of options, strategies, and concepts at your own pace. Many of you asked about further education, and Shawn, thank you for the plug on that as well. Please visit optionseducation.org, the OIC's website, and you can see the Getting Started section for further reading. Ladies and gentlemen, thank you for attending, and we hope to see you again next time.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.